Hey everyone, and welcome to The Explainer. Today, we're going to tackle a term you hear all the time, index investing. It's often called one of the smartest, simplest ways to build wealth. And you know what? In the next few minutes, we're going to break down exactly what it is, how it actually works, and what you really need to know to get started. So let's just start with a really simple question. Do you ever wish you could just invest in the entire market's growth, without all the stress and the guesswork of trying to pick the next superstar stock? Well, if you're nodding your head right now, then you've come to the right place, because that idea, that's the very heart of index investing. So here's our game plan. First, we'll cover what index investing actually is. Then we'll get into the pros and cons, the good and the bad. We're also going to bust the set and forget myth, and we'll finish up with a really practical choice, ETFs versus investment trusts. Sound good? Let's do it. All right, first things first. What in the world is index investing? Let's get right down to the big idea behind it all. Okay, here it is in a nutshell. Index investing is what we call a passive strategy. Your goal isn't to be some stock-picking genius who outsmarts the market. No, the goal is much simpler. It's to be the market. You're just trying to get the same return as a whole market index, like the S&P 500, by owning a tiny piece of everything in it. And this is where you can really see the difference. Active investing, that's the classic approach, right? You've got teams of analysts and fund managers working around the clock, trying to find that one hidden gem. It's a ton of effort, and because you're paying for all that brain power, it's usually pretty high cost. Passive investing is the total opposite. You're not looking for the winner. You're just buying a slice of everything. I love this analogy because it's so perfect. Why drive yourself crazy searching for that one magic needle when you can just buy the whole haystack? I mean, think about it. With an index fund, you get the good needles, the bad ones, and all the average ones in between. And historically, the performance of the entire haystack has been pretty tough to beat over the long run. But of course, no investment strategy is perfect. It can't all be sunshine and roses, right? So that brings us to the really crucial trade-offs. Let's dig into the good and the bad. On the plus side, the advantages are pretty clear. It's low cost, it's super simple, and you're instantly diversified, which means you're not going to get wiped out if one single company goes belly up. But the flip side is just as real. You give up the chance of that one stock making you rich overnight. And if the whole market takes a nosedive, well, you're going down with it. The most important thing to get is that your risk is reduced, not totally gone. Okay, let's move on, because this next part is one of the most misunderstood ideas in all of investing. We're talking about the set and forget myth. In Japan, they have this fantastic word for it, hottarakashi. It literally means to just leave something alone. And people use it to describe index investing all the time. But here's the catch. It doesn't mean you can just completely ignore your investments. It means don't panic, don't fiddle with it. But it absolutely does not mean you can just close your eyes for 30 years and hope for the best. And that's the real paradox here, isn't it? To be a successful passive investor, you actually need a very active kind of discipline. It's all about sticking to your plan, especially when every fiber of your being is screaming at you to sell during a downturn. It's the discipline of not chasing the hot new thing. So that begs the question, right? If you're not supposed to just forget about your portfolio, then what are you supposed to do? Well, there is one single essential task that really separates the successful long-term investors from, well, everyone else. And that crucial task is called rebalancing. Let me paint you a picture. Let's say you started with a plan, 60% in stocks, 40% in bonds. Simple. But then stocks have an amazing year. Suddenly, your portfolio might have drifted to be 70% stocks and only 30% bonds. Without even realizing it, you're now taking on way more risk than you originally signed up for. Rebalancing is just the simple act of selling a few winners to get yourself back to that original 60-40 mix. And it's not complicated. It's really just a simple 3-step dance you do, maybe once a year. First, you check in and see how things have shifted. Second, you sell just a little bit of what did really well. And third, you take that cash and buy a little more of whatever was lagging behind. It's a system that forces you to buy low and sell high without letting your emotions get in the way. All right, let's bring this home. For our final section, we are getting practical. Let's say you're on board with this whole idea. How do you, actually do it? That brings us to ETFs versus investment trusts. So these are the two main vehicles. Think of them like containers that hold all the stocks of an index. They might even hold the exact same companies inside, but the way you buy and sell them is totally different. And the biggest difference, the one that really matters, is that one of them trades all day long, just like a stock, and the other one doesn't. Let's just break this down. On one hand, you have ETFs. That stands for Exchange Traded Fund. They're listed on a stock exchange, so their price goes up and down all day long. On the other hand, you have investment trusts, which you might know as mutual funds. They're not on an exchange, and they only get priced once at the end of the day. As a general rule, this means ETFs often have lower fees, while trusts might give you a much wider variety of funds to choose from. So, which one is for you? Look, it really boils down to this. If you're the kind of person who wants the flexibility to buy or sell at a specific price during the day, an ETF is probably your best bet. But if your plan is to just automatically invest a small set amount of money every single month, and you want a ton of options, then an investment trust could be a better fit. There's no single right answer. It's all about your personal style. So let's wrap this all up. If you only remember 4 things from this whole explainer, make it these. 1. Indexing is about matching the market, not outsmarting it. 2. Its biggest strengths are that it's low cost, simple, and diversified. 3. And this is so important, set and forget is a myth. Success takes discipline and rebalancing. And 4. Your first practical step is to pick the right tool for the job, an ETF or a trust that fits your style. And that brings us to the final thought, really the most important question of all. The strategy in index investing is beautifully, wonderfully simple. But the discipline to stick with it through all the ups and downs the market's going to throw at you for decades, that is the hard part. The real question isn't whether the strategy works. It's whether you're ready to play the long game and let it work for you. Thanks for joining us on The Explainer.